Well, it was the best of times. It was the worst of times. Hi, I'm John McNeil, and this is the Invest Strong Network. Welcome. The numbers for the stock market are in final numbers for 2020, and very much like that line from Charles Dickens' Tale of Two Cities, it really was the best of times, and if not the worst of times, certainly the less better of times for many investors. Okay, the the best of time crew were these persons who invested in these technology shares, high flying growth stocks, whatnot, right? The NASDAQ composite, which is basically a meter of those technology and growth companies. The NASDAQ up an astounding of 43% in 2020. 43%. Whereas the Dow 30, the Dow Jones Industrial Average, which is made up of 30 industrial stocks, kind of the old-fangled industrial growth stocks, most of them dividend payers, was up only 9.45% with dividend included. Now, here's the funny thing. If you take away the 2.15% dividend from the Dow and also exit out the performance of Apple and Microsoft, which are two components of the Dow 30, then actually the Dow's total return falls all the way down to below 5%, right? Now, this rather shocking juxtaposition of returns is something that every investor in 2021 needs to be familiar with, right? The the performance of these two very different stock issues, this cannot go on. Right? I'll just put it this way: as a historian and as a long time, investor in equity mutual funds and individual shares, I just know for a fact that there's just no way that these growth stocks, technology issues, whatnot, there's just absolutely no way this is sustainable, that they could go on producing above 40% total returns, whereas the industrial stocks, the value stocks, the dividend payers are lagged by some 35% in total returns. It just cannot happen, right? So at some point, either this year, 2021, or certainly by 2022 or 2023, the stock market writ large will return to the mean, right? So that means the high flying growth stocks will have to come down, and the underappreciated value shares will have to ascend to, at some point, there's an equilibrium, right? Now, saying that does not mean that the high flying tech stocks have to crash, right? They may, in fact, sell off, but it really more pretends that it'll be slower growth compared to the more rapid growth in share price of the dividend paying value stocks, to where at some point there will be some kind of equilibrium, right? So one need not be in terrifying fear of a market crash of the high flying technology and growth stocks. However, in my opinion, one has to be extremely cautious if you're going to invest in those shares. The 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 growth stocks, the technology growth stocks, can really be divided into two tiers, right? So you have the profit producing growth stocks, technology stocks, your Apples, your Microsofts, your AMDs, right? Your Netflix. And these are companies that produce profits. They will perform in either the CV-19 pandemic or even after, right? and you can look forward to growth and profits and perhaps even a small dividend payout. And in fact, I think most of them pay a modicum of dividend, not very much, but they pay, a little bit of a dividend. And so you have that. Now, you compare that to many of these high flying growth companies that are not profitable, right? And in fact, they may not be profitable anywhere in the very near future or even in the extended future. People are basically betting on their growth and profitability at some point in the distant future. Boy, that's a really big gamble to take, right? Now, I believe, in my personal opinion, after 30 years of doing this, that a much more wiser approach to investing in stocks would be to focus on the underappreciated, profit producing, very important, dividend paying value stocks, right? And there are many of them out there. Companies that have performed very, very well in during the CV-19 pandemic, and in fact are actually set to grow and provide very strong, very healthy total returns after the CV-19 pandemic has run its course, right? So I would focus on companies that pay a dividend of between 2% and 4%, right? Now, you may say to yourselves, well, what is 2 to 4%? That's nothing. That is correct if you look at it on a single year basis. But if you look at holding a particular company stock for a decade of more or more, wow, that dividend will make up an enormous portion of your total return, right? And at this particular time in history, in the United States of America anyway, oh, hey, having an extra source of income is sweet, right? The job market is crap, to be honest with you, at least for working class people, right? The job market is crap. Bonds are not paying hardly any income worth their salts. Even CDs and high yielding savings accounts are paying next to nothing, right? So with these stocks, you have the potential of capital growth. You have the potential of dividend income, right? And these things I think will be attractive enough to elevate them to ascend to a point sometime in the future, fairly near future, I think, where they will reach equilibrium with the high flying growth stocks, right? So that would be the place I would want to be. And in fact, it is the place where I am at this particular point. Now, so is Brother John saying forget about the high flying growth stocks and tech issues? Is he saying that? No, not saying that at all. Like I mentioned, there are some high flying growth stocks that even after this enormous run up in 2020, they are still profitable. They will be profitable, and in fact, their profits are growing. Their reach is growing, right? So one can focus on those, right? Yes, I'm talking about you, Apple, ticker symbol AAPL, and you, Microsoft, ticker symbol MSFT, right? Among others. And they pay, as I mentioned previously, a small modicum of dividend. So you get a little bit of income out of investing in those also. Me personally, man, I am not investing in these very high flying speculative shares that have only a modicum of profitability, or no profitability at all. So those persons who might be getting paid right now in in Amazon, or getting paid big time in Tesla and Neo and some of the other high flyers. I personally, no, sir. I'm a long term investor, and I see those company shares reverting to the mean, meaning that they will have to come down and actually come down pretty substantially in order to meet the equilibrium with their higher value counterparts, right? That day is coming, right? All right. So those are my thoughts for this week. Please, please let me know what you think. I'd really appreciate it. Smash that thumbs up button if you found this information beneficial, encouraging. I'd appreciate it. Leave a comment. I love comments. You might think I'm a crackpot. I might be a crackpot. Let me know. I can take the hit. Leave a comment. I promise you I'll respond. And of course, subscribe. Subscribe to Invest Strong. I'd appreciate it. All right. Thank you so much, friends, and good blessings.